What is going on, investors? Hopefully you guys are doing well out there. Time to keep earnings season moving right along. This time we're going to take a look at Johnson & Johnson. Might be the first time here on the channel that we'll take a look at the stock ticker symbol JNJ over the last year. Stock's up 3%. Considering this whole stock market's been down big time over the last year, that's actually pretty darn good performance over the last 6 months. We're down a little bit on this one, down about 2.7%. Now, something that gets lost maybe a little bit when we're doing these earnings videos is just kind of a broader return of a certain stock, maybe even compared to the S&P 500. When you look at JNJ over the last 10 years, stock's up, total return, that includes dividends and the stock price going up. You're looking at 197% increase on this stock. Now, look, the S&P 500, though, is up 224%. And so I just want to start this by saying I don't actually anticipate JNJ outpacing the total return of the S&P 500 over the next 10 years. Now, that doesn't mean, though, some people might confuse that by, I got to close the window and I don't need to invest in JNJ. I'm not going to beat the S&P 500. Doesn't mean that at all. For those of you that are constructing your own portfolio through individual stocks, having stocks like JNJ, which very much keep up with the S&P 500 return, and let's say you have a portfolio overweight tech, overweight energy, overweight speculative stocks, overweight any type of financial sector or any other sector other than healthcare, well, J&J absolutely belongs in your portfolio. If you're overweight all the other sectors outside of healthcare, well, a stock like this should be very high on your list. Let's go through the Q4 earnings that came in at $23.7 billion. That was the decline year over year by about 4.4%. But when we come over here and look at these companies' financials, you will see that they were impacted tremendously as it's a global company. You have the price of the dollar, which really rapidly accelerated last year. We'll show it to you from a graphical perspective. It has reversed. I actually think we have more declines to come in terms of the dollar index. Certainly compared to different currencies, it could be a little bit different, but a broad index of the dollar currency, I think we've got more declines to come, which will certainly benefit those multinational companies that we cover here during earnings week. So revenue for the full year 2023, so we got full year guidance coming up 96.9, so right at about 97 billion, up to very close to about 98 billion dollars. The consensus estimate for the upcoming year was 97.3. Some analysts expecting as high as over 100 billion dollars. So the company really kind of hitting that guidance right on the mark. The revenue was hit by that foreign exchange, which we'll talk about here in a second. You also had vaccine impact, which they had to take a charge from an R&D perspective. There also looks like they're scaling back that production, is maybe they're seeing demand kind of wane a little bit. Also, you have the other players, Moderna and Pfizer, which have really kind of taken a lead, at least from a marketing perspective as well. Johnson & Johnson maybe taking a slight back seat in terms of that. Now, the difficult situation when you look at any of these healthcare companies, any of the drug makers, any of the therapeutics out there, is they get a drug to like a phase 2, phase 3, and then they have a setback and they have to scrap the whole thing. So they were working on an HIV vaccine, which sounds fantastic if they were able to pull that off. It reached a phase 3 trial, but then they had a setback, and so they scrapped the whole thing. So the way a company like J&J, this is why, if you're a doctor, if you're a science brain and you have your finger on the pulse of medicine, you can probably go for the more speculative kind of biotech, kind of upstarts, no revenue, kind of pre-revenue, pre-profits, pre-product type companies. If you have that expertise, by all means, play in that space. I don't. And so what I tend to do is focus on companies like J&J, because the way they get into the more speculative medicines is they do acquisitions. So a Biomed is potentially how you pronounce that. That climbed 52% on a $380 share buyout deal with Johnson & Johnson, valuing the company at over $16.6 billion. There's not many companies in the world that can afford $16.6 billion in the healthcare space. Johnson & Johnson is one of them. And so you might not get that like rapid outperformance. So we talked about the performance from the stock in the beginning. If you take a real speculative stock like a Moderna a couple of years ago, or any of these other biotech stocks, which again are kind of pre-product, pre-revenue, pre-everything, they can outperform the S&P 500. But boy, you're taking a lot of risk. Johnson & Johnson is one of the few companies that can allow these smaller biotechs develop something, develop a product, develop a medical device, and then they come out here and buy them out and then profit on that company over the longer term. Now, If you're not aware of Johnson & Johnson, here's a great high-level overview of what the company does. They've got over $15 billion worldwide consumer health sales. That includes Tylenol, Motrin, and other types of medicine. Worldwide pharmaceutical business is their larger business, coming in at over $52 billion. Those prescription drugs just rake in tons and tons of money. And then finally, you have those medical technology sales, very large business, also coming in at about $27 billion. What you'll see is across the board, you saw decreases for all of these business for the most part, but operationally, which they have in the language here, this states that they actually would be up 6.7% and up 3.6% on those businesses due to foreign currency exchange. When we come over here to the DXY, there's certainly YouTubers out there and people out there that are a bigger expert on currency than I am, but what I know about these currencies is they trade in relatively predictable patterns. Technical analysis works a lot of the time for stocks. Technical analysis works a lot more of the time, in my opinion, when you're looking at things like currencies. Here's a DXY, and what we are seeing is this is essentially a US dollar. And again, you can compare this to the euro, the yen, all those different types of things and get a little bit different deviation. But what we are seeing is we had this massive rise in the dollar's value, and this just killed all the multinational companies that we're looking at. Google, Microsoft, Nike, all of them just got destroyed on this move when it came to earnings. A lot of them tried to adjust that out and tried to make investors understand that, look, our business decreased 0.5%, but if you factor in constant currency, it was 3.6%. But investors tend to ignore these types of things. And I tell you what, currencies constantly fluctuate, so I don't blame them. But things have reversed. More recently, we've seen a pretty steep reversal in this. And in my opinion, we probably have further to go. I think we're going to come back down to the bottom of the channel. That's another 6% decline. I know 6% doesn't sound like a lot, but boy, it really ultimately is when we're talking about billions and kind of $1 trillion of global sales. Now, the beautiful thing, at least from kind of a corporate global earnings perspective, is if we were to break this trend, you break this level at here at 89, you come down here and you probably are retesting 79 on this. This would just make global equities, multinational companies just continue to soar when it comes to their earnings. Now, come over here and look at this from a high-level view. We have our total revenues, $23.7 billion. Again, that's including all of the different business units. This is on a worldwide yearly basis. We are looking at just a fourth quarter basis. We'll come down here and look at it from a 12-month basis here in a moment as well. Now, what I'm seeing here with Johnson & Johnson is you got freaking tech-like gross margins on this company off of $23.7 billion in sales, just $7.7 billion worth of product cost. And that gives you gross profit of a whopping nearly $16 billion. So off of $23 billion in sales, $16 billion in gross profit. Hello, I'm loving that. And including inside of this, you actually had a decrease in your product costs, which didn't quite match your decline in sales year over year on a quarterly basis, but it was close. So you like to see that. Our gross profit did decline, but the company is doing a very nice job. Take a look at your selling, marketing, and general administrative expenses. Those were down 9% over year. So off of $7.2 billion down to 6.5, and they give you kind of a percentage of sales. Last year, selling and marketing was nearly 29%. Now it's just 27.4% of sales. Also, research and development, a big cost over at this company to the tune of $3.8 billion in a quarter. That is down 18.6% year over year and just 16.2% of sales when last year it was at 19. So yes, sales basically went flat, down a little bit, but they cost controlled on the product side. They cost controlled even better on the sales and marketing side, and they cost controlled even better than that on the R&D side. They did have some other expenses here related to COVID, related to FX that really impacted your net earnings. So you see your net earnings year over year down 25% from $4.7 billion down to $3.5 billion. But a lot of that happened to do with kind of like non-reoccurring, in my opinion, expenses. Everything else looks pretty darn good. And if this company can kind of reaccelerate even to kind of like low single digit growth, and look, there's not an analyst on Wall Street that's really projecting anything other than kind of slow single-digit churn out growth on that revenue side, they can couple that by cutting cost. I tell you what, it's a recipe for a winning investment over at JNJ. When you look at this for the full year, you get a full year, $95 billion worth of sales. You see on the full year, you actually had an increase of about 1.3%, and they coupled that by dropping the R&D expenses a little bit. Your sales and marketing barely ticked up. When you flow down to net earnings, you do have these other expenses, and you had a large increase in income taxes over the year over year, up 99% on that income tax side, from 1.9 billion all the way up to 3.8. So both of those things really hurt earnings. But if you just look at this from an operating perspective at J&J, it's a thing of beauty. Yes, you just have low single-digit sales growth, but they've coupled that by keeping costs either where they're at or dropping them just slightly. That will maintain your operating profits. Things looking pretty good from an operating perspective when it comes to J&J. Now, what's also looking good is a stock chart that is in basically a decade-long uptrend. Anytime this stock is pulled back to, it's a green line, I'll change it to purple to make it a little bit more obvious. Anytime you've pulled back to this line, well, I tell you what, over the last decade, it has basically been a buying opportunity. I am on a weekly chart here, and here we are a stone's throw away from this purple line. So if you like this stock, this can be a buying opportunity. Now, some of you might say, well, at some point, past performance, past technical analysis might not meet further and future technical analysis. You might be right. Creating lower sets of highs here could be a topping pattern. I mean, I guess, but in the past, these lower highs have materialized multiple times. I mean, anytime this stock pulls back from the top of the trend down to the bottom trend, you are going to have a reversal in trend, at least in the micro trend time. If you want to be an ultra safe investor, you don't want to lose your principal. I tell you what, over the last year, look, nobody's posting videos on YouTube about risk management. It just would get like 0.0 clicks. But here's how I would play this one. I would buy this one about where it's at right now. There's an area of support for the stock right at these levels. We'll call it between maybe as low, I wouldn't really go as low as 150, but 155 to 160, somewhere in this range. You would not want this stock to break below that. That would, in my opinion, kind of signal a break in this trend. And I really wouldn't be excited about seeing where this one could end up. You could look at a chart of Netflix. You could look at a chart of Meta. You could look at a lot of charts, especially in the tech sector. Once you break kind of a longer term trend, things can materialize and break down very quickly. But based on the steady business that this company has, based on the fact that you are getting a 2.69% dividend yield on this one, over $4.50 per share, the company could just jack up these dividends even higher if it felt like. It will continue to be active in the M&A category, allowing these speculative biotechs to establish products, get it through trials, start to get sales, and then J&J kind of brings it up in there into its family of products. And it obviously has a gigantic business when it comes to pharmaceutical sales and kind of the medical technology sales as well. That was Johnson & Johnson. I love this stock, particularly if you're like me and you're overweight tech, you're overweight all this other stuff, you don't have a lot of healthcare exposure. Johnson & Johnson will give that to you. I would not anticipate this stock outperforming the S&P 500, but it certainly can diversify a portfolio where you are trying to outperform the S&P 500. It can give you a little bit of margin for safety underneath that. That was Johnson & Johnson. We'll be back again later today with Microsoft. Good luck with your investments.